I want to move on here to hit a few hot topics that we heard about at last week's Inside ETF conference. First, the continuation of the fee wars. Now, we're in a race to zero for index funds, but fees are coming down right across the board. Jeremy Schwartz, what does it mean for a firm like WisdomTree? There's fee compression everywhere. That's got to be an issue for you as well.
When we started our first 20 ETFs in 2006, it was already low. I mean, the beta ETFs were 9 basis points when you started. You have to have differentiation. You have to add value. You just can't be a beta solution, right? So that's WisdomTree calls it modern alpha, trying to create systematic, rules-based, value-added portfolios. But
well, look, I would just point out they're putting up your stock here. I mean, it's been under pressure for over a year now. I can't help but think that part of that is due to the fee issues for you as well. I mean, that's got to be a major problem.
We had two sort of blockbuster funds in 2013, 2014 that raised a ton of money, and then they've been under pressure. This Currency Hedge International with Japan and Europe. We still believe very much in the broad case that, and actually the developed international broad solutions are actually starting to see a lot of more interest from us. But that's what's going on really, is as you had a huge inflows, it's been sort of bleeding out, but it's, we think it's stabilizing. It was the least amount of outflows you'd say, in 5 years last quarter.
Yeah, and as the ad says, with Professor Siegel, actively managed ETFs are the future, and of course you're seeing that too, where there's a whole movement here to bring non-transparent active management into the ETF space this year.
We've been sort of very public that we're more about index-based and transparent active than non-transparent.
Go ahead, Professor, you wanted to say something?
Yeah, I just wanted to mention, Bob, you're absolutely right. The downward pressure on expenses, and that's why in these portfolios we paid a lot of attention to minimizing our expenses. Really a very low expense ratio for these Siegel portfolios, and that was kept in mind because of exactly those competitive pressures that we all face today.
Okay, let's move on here and address some thematic ETFs and ESG subsector of thematic ETFs. Cannabis was hot last year and then it fizzled. Now it's trying to come back again. What's going to be the hot thematic ETFs this year? Jeff, I know this is a tough pick. I know it's sort of like a popularity contest, but everybody likes it. Let's just isolate ESG for a minute. And anything out there that's really going to catch the public's attention this year?
Well, certainly people are still reeling from cannabis last year, and it did go up in smoke. But this year, technology continues to be the #1 sector, but that's a little bit boring. So I want to go back to the fact we talk about this defensive component, right? And when you're looking for in the 128th month of this historic bull cycle, I think we have to realize that Microsoft and Apple can contribute another 15% to last year's 30% gain in the S&P 500. So I think you have to stick with value. I know value is a little bit boring right now, but I think you have to understand some of these ETFs can give you a broad swath exposure, but sticking with technology, sticking with utilities until the relative strength diminishes, I think that's where you want to be in 2020. These themes will persist from 2019, they'll carry over to 2020.
Jeremy Schwartz, he mentioned tech is boring, but I see continuing interest on the part of our viewers on exponential technology type ETFs, in robotics, in AI, in genetics, disruptive, that is going to go right across the board and influencing. Like artificial intelligence is really going to influence virtually every industry that's out there. It's hardly even an investable area since everyone is going to use it, but there's continuing interest in disruptive technologies as an investment.
We see that all the time, and we are ourselves investing in some of these thematics like a cloud computing and things like modern tech platforms. But I think one of our big themes for 2020 is this rotation back to value, and going back to Professor Siegel's work on, you got to be careful what you pay for these things, and people get overly excited. They often overpay for growth. We called it the growth trap in the future for investors, and so that's the return for 2020.
I think Jeremy brings up a great point. In owning sectors that continue to reveal strength and staying away from the sectors that are not revealing strength. Oil, in specific, oil had a disastrous year in 2019. It's down 11%, the worst sector in the S&P 500 this year. So stay with what's working, stay away from what's not.
Professor, let me get your thoughts on ESG, environmental, social, and governance. I've been saying for a year and a half that it was a little bit of a joke 2 years ago in the investment community because everyone said, well, of course we're in favor of ESG. Who isn't? But where's the money? Nobody was putting any real money in. In the middle of last year, that started to change, and we started to see significant inflows. There was a big debate at this ETF conference last week. Exactly what is ESG? My ESG is not your ESG, and the industry really has to tighten up the standards a little bit. Can you give us your thoughts on ESG and where it fits in anybody's portfolio?
Well, you're right. I mean, there's not a big bright switch. I am or I am not ESG. Just like there wasn't a bright switch, are you a value stock or not, right? I mean, some will be put in those categories, other will not. one has to also be very careful. I mean, I've seen some historical studies about outperformance of some of these ESG stocks historically, but remember, if everyone's moving to them, that causes outperformance, but if it leads to too high valuation, it leads to long-term underperformance.
Right.
So you got to be really careful of that. I'm very wary of saying, oh, in the past, these have done well, and they've come up recently, people are buying them, and then saying, oh, that means it's going to do well in the future. I also want to mention something about value and growth. During this pressured part on the coronavirus, growth is still outperforming. The FANG stocks are still doing relatively well. I'm waiting for that turnaround. I don't see it right now, but deep down, I know it's going to happen because history tells us when people wake up and say, hey, I need yield, that's what I'm going forward, you're going to see that turnaround. But we don't see it yet. We just don't see it yet.
Okay. I don't want to get into the whole value versus growth thing because I have my own thoughts about that. I want to go back to his point on ESG, which is very true, which is distinguish between a momentum play where all of a sudden ESG does better because people are putting money into it and actual fundamental outperformance, and don't confuse one with the other. That's a very good point the professor makes. Will it attract more assets, and will we get that? Will suddenly ESG become a momentum play?
Potentially, and I think what's interesting, the ESG conversation we have with all the financial advisors we talk to across the country, it's that next generation, Bob, it's those millennials. They want to be invested in ESG. We don't know the structure, it's very loose right now, but they want to be invested. So I think it is going to continue to grow exponentially over the next 5 to 10 years.
All right. Final thought?
We're going to hear more from WisdomTree on this issue as well over time, also making sure we're factoring in valuations, quality ratios, things that broad multi-factor type incorporation.
Spoken like the senior investment advisor that you are.